S&P 500 futures are slipping about 0.1% in the pre-market here. NASDAQ is taking a much heavier hit, down 0.5% on some early semiconductor profit-taking, and the Dow is just hovering flat. It is Thursday morning, July 2, 2026, and the implied open is setting up an incredibly dangerous tape.
Yeah, the overnight session really set the tone here. I mean, the entire market is laser-focused on one thing, and that's the June Nonfarm Payrolls report dropping at exactly 8:30 a.m. Eastern.
Right, and the whisper numbers on the street are looking for a pretty modest, 110,000 to 115,000 jobs, with unemployment holding steady at 4.3%. But honestly, the actual numbers are almost secondary to the macro environment they're landing in today.
Exactly. What's fascinating here is that we've officially entered what institutional desks are calling the Warsh regime.
Oh, yeah. This is huge for anyone putting money to work right now. Let's break that down for everyone.
So, Federal Reserve Chair Kevin Warsh has completely abandoned the old forward guidance playbook. For, the last decade? The central bank would carefully telegraph every single move months in advance.
Right. They held the market's hand. It was a GPS for traders.
Precisely. They managed expectations so you never had to panic, but that era is definitively over. Warsh made it clear they are reacting to the data as it comes.
Which means today is essentially a pure data event.
100%. There is zero central bank safety net managing forward expectations right now. So every single economic print, especially a massive labor market report, it has the potential to just violently reprice the entire equity market in milliseconds.
And we have to combine that lack of a roadmap with the actual physical playing field we're on today, because the calendar itself is creating this massive structural hazard.
Oh, a pre-holiday dynamic.
Right. Tomorrow is Friday, July 3rd.
Yeah.
U.S. markets are closed for Independence Day.
Yeah.
And the institutional briefings are explicitly warning that we are sitting in and this is a mouthful, a pre-holiday liquidity trap with distribution characteristics.
It sounds super academic, I know.
It does. But the actual mechanics of it are critical if you're trading today.
Well, it really comes down to the options market wagging the dog here. The dealers, the major market makers providing a liquidity, they're the true drivers today.
Because the pre-market volume is already looking a bit anemic, right?
Yeah, because we've got a long weekend kicking off tomorrow. Trading volume is going to just completely evaporate after the morning session.
Right.
The order book is remarkably thin. And when it's thin, it takes significantly less buying or selling pressure to move the entire index.
Which brings us to the actual levels. The notes highlight two specific lines in the sand for the S&P 500 today. We've got a formidable call wall resistance up at 7,500, and then right below us, a critical gamma flip point at 7,455.
Yeah, that 7,455 level is the one to watch.
Let's actually unpack the plumbing there.
Right.
Why does that specific number dictate whether we get a calm Friday Eve or a total market meltdown?
Okay, so market makers, they aren't in the business of directional betting, right? They just want to capture the spread.
They're the house. They just take their cut.
Exactly. So when they sell options, they have to hedge that exposure by trading the underlying stock. Right now, dealers are sitting in what's called a long gamma position between that 7,455 level and 7,500.
And mathematically, long gamma means their hedging algorithms are mechanically forced to buy the index when the price dips and sell when it rallies.
Right. It acts like a structural dam holding back volatility.
So they're just buying the dips and selling the rips, pinning the S&P in this really tight, calm range. It looks totally normal.
It looks benign, but here's the trap. It creates this pre-holiday drift that lulls retail traders to sleep. But if that 8:30 a.m. jobs report shocks the system and the S&P drops below that 7,455 line in the sand,
The dam breaks.
the dam completely breaks. The dealer positioning mathematically flips to short gamma.
In short, gamma requires the exact opposite behavior.
Precisely. They have to aggressively sell into a falling market to neutralize their risk. They must sell the dips.
Wow. Okay, so picture this. You get a shockingly hot or cold jobs report. Initial selling hits. The index crosses below 7,455. Suddenly, the biggest players are forced to dump huge blocks of futures into an empty pre-holiday order book where there are literally no buyers.
Right, the downward spiral just becomes reflexive and instant.
Let me push back on this a bit, or at least ask a pointed question here. Retail traders are looking at the tape this morning. They see the S&P down just 0.1%, and they think, hey, everything's fine. Are they essentially walking blindfolded into a minefield?
In a word, yes.
Because if they mistake this artificial options calm for a healthy market, one bad jobs number could cause this spring to just violently snap.
Right.
and the liquidity won't be there to fill their stop losses.
That is the textbook definition of the liquidity trap we're in today. You just cannot trust the surface level calm. The volatility is being artificially suppressed by dealer hedging. It is not actual underlying conviction.
Okay, so keeping that incredibly fragile tape in mind, we need to transition to the sector feeling the absolute most pressure in the pre-market right now, and that's tech.
Oh, yeah. The AI infrastructure trade is having a complete identity crisis today.
It really is. The pre-market gappers are showing us some massive winners and losers, and the divergence is just staggering. Let's look at Meta platforms first.
Meta is surging, what, nearly 10%? Trading around $612.91 right now.
And this gap up is entirely driven by the news overnight of Meta Compute. Over the last couple of years, Meta has hoarded, I think it's roughly 350,000 H100 GPUs.
Yeah, massive stockpile.
They built this colossal infrastructure for their own internal AI training. But now they're officially carving up that excess computing capacity, partitioning it, and just leasing it out to enterprise clients via an API.
They're essentially launching a cloud business overnight to compete with AWS and Azure.
Right. And Wall Street loves it.
Well, it's a brilliant narrative shift. I mean, for the last 18 months, the main bearish thesis on Meta was that they were just incinerating capital on AI, right?
Building endless data centers with no clear path to profitability.
Exactly. But by renting out their compute, they instantly transform that massive AI cost center into a high-margin revenue stream. They figured out how to monetize the hyperscale overspending on day one.
Okay, let's unpack this, though, because I'm going to challenge that bullish narrative. Look beneath the surface here. If you build a massive factory for your own products, realize you made it way too big, and then brilliantly decide to just rent out the extra conveyor belts to your rivals.
That's a great analogy, yeah.
It screams of a utilization failure. Doesn't this pivot signal a glaring red flag that the hyperscale AI industry has just massively overbuilt its infrastructure?
I mean, I see the logic there, absolutely. But institutional buyers are interpreting it totally differently this morning. In tech infrastructure, idle compute is toxic.
Yeah.
So even if Meta's internal AI takes another 3 years to fully mature, this pivot ensures those CapEx billions are generating an immediate yield. It's pure capital efficiency. But your point about the industry potentially overbuilding, that is the defining question right now. And you can see the darker side of that AI hype cycle playing out with Micron Technology today.
Yeah, let's pivot to Micron, because this is the exact opposite side of the coin. Micron plummeted 10% on Wednesday, and they are sliding another 2.1% in the pre-market today, sitting right around $1,010.
And what makes this so shocking is the earnings context.
Right. They just reported a record-breaking Q3. I mean, they posted earnings per share of $25.11. They completely blew past the $21.79 estimate.
Yeah.
A historic beat.
Massive beat.
And yet the stock is just being hammered because of this new U.S. class action lawsuit alleging they conspired to manipulate DRAM memory prices with Samsung and SK Hynix.
Which proves that the AI memory hype cycle is officially colliding with regulatory reality.
But why does a civil lawsuit completely erase a historic earnings beat overnight? Companies get sued all the time.
It comes down to the multiple. At these extreme high valuations, investors are paying for earnings that are projected years into the future.
Right, price for perfection.
Exactly. So a price-fixing lawsuit introduces the possibility of severe financial penalties or an injunction that restricts their pricing power. At these elevated levels, there is absolutely zero room for error. The second that pristine growth narrative gets threatened, institutional capital just liquidates immediately.
Which perfectly brings us to the ultimate valuation test happening right now. While the AI infrastructure trade is having this identity crisis, another huge retail favorite is facing a perfect storm of catalysts today.
You're talking about Tesla.
Tesla, up 12% on the week, trading around $425.30. They have a trio of major updates hitting the tape today.
It's a very busy morning for them.
Q2 delivery numbers are dropping. Wall Street consensus is 406,000, but retail is aggressively getting on a beat above 475,000. Plus, you have FSD version 14 Lite rolling out, and the NHTSA just officially closed that 2022 Phantom braking probe that was hanging over like 695,000 vehicles.
Okay, but if we connect this to the bigger picture, there is a massive hidden divergence here between what retail is doing and what institutional money is doing.
Explain that.
Well, the retail crowd is aggressively buying into these micro-catalysts. They are conditioned to buy the tech dip on autopilot. But institutions, they are looking almost exclusively at the macro overlay.
And the most important metric in that macro overlay today is the U.S. 10-year Treasury yield. which is sitting at a very stubborn 4.49%.
That yield is the anchor holding down the entire tech sector. To understand why institutional whales are fading this tech rally, you have to understand the denominator effect.
Okay, let's take a second to thoroughly explain the math behind the denominator effect, because this is literally the fundamental tug-of-war happening today.
Right. So when an institutional analyst values a high-growth company like Tesla, they use a discounted cash flow model. They project all the profits the company will generate over the next 10 or 20 years.
And they discount those future dollars back to what they're worth today.
Exactly. And the specific rate they use to discount those earnings is the risk-free rate, which is directly tied to that 10-year Treasury yield.
So just to do the quick math, if the risk-free rate is, say, 2%, a dollar earned 10 years from now might be worth roughly 82 cents today. But if that risk-free rate jumps to 4.49% and stays there, that same future dollar is suddenly only worth about 64 cents today.
Spot on. Now multiply that difference by tens of billions of dollars in projected future revenue.
Wow.
Yeah. As the yield goes up, the mathematical present value of those distant future earnings just collapses. The 10-year yield acts as a gravitational pull on tech multiples.
So this really highlights the danger of the retail playbook right now. I mean, for the last 10 years, tech always bounced back because money was practically free. But if that 4.49% yield acts like a restrictive gravity well, are retail investors just catching falling knives here?
Pretty much. They're playing this catalyst gap-and-go game, buying the FSD update, while institutions are quietly walking out the back door to lock in guaranteed bond returns.
Is this what they call the institutional pain trade?
Yes. The pain trade is rarely this sudden dramatic crash. It's usually a prolonged, agonizing, sideways grind where mega-cap tech just slowly bleeds out its premium valuation. Retail gets left holding the bag, waiting for a bounce, while institutions just refuse to play. I mean, why risk capital on a stock priced for flawless execution in 2030 when you can just collect a guaranteed 4.5% yield today in treasuries?
That perfectly sets up our next major theme.
Mm-hmm.
Because capital has to flow somewhere,
Yeah.
right? If the smart money is fleeing the gravity well of high-growth tech, where exactly are they hiding out during this pre-holiday chaos?
We're seeing a very deliberate rotation into consumer defensives and financials.
Boring stocks.
Very boring. But they are hunting for hard, cash-generative value that performs no matter what Kevin Warsh and the Fed do. High-yield defensive dividend ETFs have quietly surged 19% year-to-date in 2026.
And the briefing notes highlight a brilliant example of this happening in real time today. National Beverage Corp, ticker symbol FIZZ, they make LaCroix sparkling water. FIZZ is surging over 6% in the pre-market. They posted a massive $1.2 billion sales beat. But the actual revenue isn't what institutions care about today, is it?
No, not at all. It's the fact that they declared a special $3.25 per share cash dividend.
Wow. $3.25 per share.
That dividend is the entire thesis. While retail is fighting over who's going to win the AI infrastructure wars a decade from now, the smart money is aggressively buying a sparkling water company.
Because it generates immediate, tangible cash flow.
Exactly. FIZZ represents exactly what institutions want right now. Yield-generating, cash-heavy safety.
But this rotation into defensives isn't just about finding yield. It's also about protecting capital from the real economic slowing happening outside the Wall Street bubble.
Oh, absolutely.
Look at the flip side of the broader economy today. Franklin Covey is plunging over 20% this morning.
Yeah, that was a brutal print.
They actually turned a profit in their most recent quarter, but they abruptly slashed their fiscal 2026 revenue guidance down to $260 million. And the catalyst is fascinating. Abrupt state budget cuts are severely hitting their corporate education and training segments.
It's a very sobering reality check. When state governments are forced to aggressively slash budgets, those cuts ripple directly into corporate training. It shows that the macro slowdown the Fed has been trying to engineer. It's here.
So what does this all mean for the listener? If we pull all these threads together, the institutional rotation is basically like seeking shelter in a sturdy, boring brick like FIZZ in these defensives, rather than hanging out in a flashy, fragile glass mansion like overvalued tech while a massive storm gathers on the horizon.
That's a highly accurate way to frame it. You do not want to be over-leveraged in a fragile asset when that volatility dam we talked about at 7,455 finally breaks.
All right, let's summarize the actionable intelligence here. Today is a highly volatile, data-heavy Thursday with absolutely no Federal Reserve forward guidance to catch the market if the jobs report surprises the tape.
We are flying blind.
The S&P 500 is teetering right above that critical gamma flip point at 7,455. It's setting the stage for a dangerous pre-holiday liquidity trap. Tech giants are exposing cracks in the AI build-out, with Meta leasing excess capacity and Micron getting crushed by lawsuits. And underneath it all, institutions are quietly hiding in boring, cash-heavy defensive stocks to escape the 4.49% Treasury yield gravity well.
It's a massive shift, and I'll leave everyone with one final thought to mull over today as you watch the tape.
Yeah, go ahead.
As you watch this AI infrastructure race unfold in the headlines, consider this. If the biggest tech giants in the world are now forced to rent out their excess AI data centers to their competitors because they built too much, what does that mean for the next wave of technological innovation? Are we looking at the dawn of cheaper, democratized AI for everyone? Or are we witnessing the very first structural crack in a multi-trillion-dollar bubble?
The GPS is smashed, the fog is thick, and the turn is approaching faster than anyone anticipates. Thank you for joining us on this deep dive into the institutional briefings. Keep your stocks tight, question the consensus, and we will see you next time.